Welcome back. As promised, let's invite Neeraj Chadawar, Head of Fundamental and Quantitative Research at Axis Securities. Neeraj, thank you very much for joining us on the show. This is Rima here. Wanted to get your thoughts in on IT. Where do you stand in the debate? There is a Nomura which has turned incrementally bullish just today, even after the 15% run-up that we had in the last 1 month. But then the valuations are higher than average multiple, and it's not that the demand is picked up today. There is anticipation of a demand pickup in the second half of the year. So to some, it looks to be a bit excessive, the run-up and the valuations. Where does Axis Securities stand in IT, and what's the best way to play it?
Yeah, thank you for having me on show. So you rightly pointed out that in our yesterday's topics report also, we have added one IT stock, that is SCL Tech, in our topics recommendation. Now we believe that at current juncture, most of the positives are priced in the market, and market is likely to adjust to the fundamental going forward. And Q1 FY25 earning will be the best time in which market will adjust to the fundamental. And at this juncture, we believe that there is a more margin of safety in the large cap space as compared to available in the broader space. So risk reward is in the favor of large cap, and based on that, quality which is available at a reasonable price and growth which is available at a reasonable price is a better theme to going forward. And we believe that in the near term, market positioning is likely to shift towards the domestic towards the defensive name from the domestic cyclical. So that's why private banks, IT, pharma, telecom and consumption will provide more margin of safety at this current juncture. So that's why as a part of style rotation and sector rotation, IT is the best bet at this current juncture. We believe that most of the negatives are priced in Q1 FY25. We believe that the IT could made a bottom. Going forward, the downgrade risk is very, very limited in the IT stock, and we believe that with pickup in the second half of FY25, more ramp up in the deal wins, there are green shoot available in the second half for the IT sector. So this is the best time as compared to on a relative basis. IT is the best bet at current juncture.
Okay, Neeraj Chadawar, yeah, I'm seeing your top recommendations, and I think HCL Tech is one stock that you particularly like. But just to complete that point on IT before we talk on the sectors. Now, do you think the best way to ride this improvement is through large cap names like an HCL Technologies, which is on your list, or would you continue to look for some of the niche mid cap IT plays as well? So how do you sort of ride this IT momentum?
So, you rightly pointed out that at this moment we are very selective in IT space. We still believe that we still need to see how the commentaries pan out in Q1 FY25 earnings season, which likely to start from next week onward. We believe that at this juncture, being selective in the market from the IT sector, but we believe that in FY25, IT could emerge as a dark horse sector, because if we see the US economy on a quarter-on-quarter basis, it started showing improvement on a sequential basis. So we started 2024 with some downgrade expectation in IT. Most of the downgrades are already in price. Going forward, we could see some amount of positive upgrades in IT sector, and with positive upgrades, we will see the stock prices will follow those upgrades. So this is a better time to shift some amount of money in the IT sector, which we recommend. And at this juncture, we like SCL Tech because valuations are very attractive in this place.
Fair. Okay, now Neeraj, let's come to your overall market call, and you're fairly constructive on the market as well. You're expecting, I think, a 16% run rate for earnings all the way up to FY26. And you seem to like financials. So let's come to the overall portfolio construct, because the thing is to buy a fresh now at all-time highs in the market's not even giving you too many meaningful dips, right? So to construct a new portfolio right now is a real challenge. So help our viewers do that. If someone has to put fresh money to work, you singled out IT as a sector, but where would you deploy the bulk of that money then?
Yes. So we are very constructive on the Nifty earning per se. We are believing that in our base case assumption, we are expecting 16% earning growth for Nifty 50 starting from FY23 to FY26. So in our base case assumption, we believe that we are having a target of 24,800 for March 25. That is a base case target. In bull case target, we are assuming that Nifty could touch 27,000 mark by March 25. Our bull case assumption is based on the Goldilocks scenario, in which the overall agenda of soft landing in the US market, rate cut expectation starting from September onwards in the US economy. Along with that, the 16% CAGR could convert it to 17 to 18% CAGR for the Nifty 50 earning growth. We believe that the chances of bear case at current juncture is very limited. Now, in last 1 month, the market has evolved and most of the things are priced in. From last 3 to 6 months, market was most of the narrative-driven market. We believe that most of the narrative-driven volatility is already factored in. Now, the India VIX is trading around 13 to 14 level, which is far below the long-term average. So it is evident that market is due for style and sector rotation at this juncture. Any fresh and incremental money could go into in the defensive play or the quality play where the reasonable valuations are there. So right now we are betting high on private banks. We believe that private banks were the underperforming as compared to the PSU banks, and at this juncture private banks provide, especially the large cap private banks, provide more margin of safety, and all levers are in place for the double-digit credit growth because they already started with the deposit mobilization. So recently we have added HDFC Bank in our top picks recommendation. We continue to recommend ICICI Bank in the large cap space and SBI in the large cap space, and in the mid cap space we continue to like Federal Bank. The second sector is the telecom sector. We believe that telecom sector is now a multi-year theme. All the negatives are already in place. Now going forward, we will see the recovery in the telecom sector. Now it will be a 2+1 market, and the weaker player is also able to raise the money, and the ARPU cycle is just started after the 2 years of deep pain. We believe that going forward, and at this juncture, price hike can be easily absorbed by the market, and we believe that going forward it will be a 2 to 3 year theme based on the multiple operating metrics recovery in upcoming years. The next sector is the pharma sector. It is again a defensive sector. Given the current market structure, we believe that pharma is in right place. The pricing war in the US market is now behind us. Each and every company is targeting on the niche molecule, and we believe that at the current juncture, they provide more margin of safety in terms of valuation as compared to the overall market. Now, consumption is a very interesting theme, and we are at a very interesting juncture for the consumption theme. Now, this year, the monsoon is expected to be a very normal monsoon. We believe that this will likely to translate into a double-digit volume growth in the second half of FY25. On top of that, there is a leeway available for the government in terms of RBI dividend that could likely to be translated into some amount of rural focus scheme, which likely to announce in upcoming budget. We believe that all these levers are likely to translate into a good growth in the second half of FY25. So these are the themes one can place the fresh money, and on top of that, under consumption, we are very confident on the QSR as a recovery. The QSR team has already made a bottom, and we believe that going forward we will see the sequential recovery in the QSR.
Can you zero in a bit more about this QSR recovery? Because the anecdotal evidence doesn't seem to suggest that there is a recovery underway in QSR. So many people who've done channel checks still seem to suggest that it's demand is fairly subdued. So what gives you that confidence, and when are we likely to see that recovery, and how do valuations pan out right now?
So we believe that the QSR is a very good relative trade in the overall consumption space. We are believing that the consumption is likely to pick up going forward. In the second half, we already seen the green shoot in the urban consumption. Now, based on the rural growth, along with the government top up on some of the rural schemes, along with the normal monsoon, MSP lever, all likely to translate into good consumption growth for the second half. And at this juncture, valuation for entire QSR space is very, very attractive, and the stock has really underperformed as compared to the market. So that provides more margin of safety at the current juncture going forward. So that's why we believe that this is the best time to deploy money in the QSR space, and we will get the recovery in the second half of FY25.
Okay. All right, Neeraj, we will leave it on that note. Thank you very much for joining in. Good having this conversation with you today. We will take a quick break on that note. Come back on the other side with a lot more on the market.